Each month, I conduct a portfolio update as a digital diary to track my investment progress. I am a firm believer in total transparency on YouTube, which means sharing every detail of the portfolio, including any losses. As your journey as an investor evolves, this video serves as a reference point to see how much you have matured or how your strategies have shifted. Within these updates, I disclose the total value of my dividend growth stock portfolio, performance metrics, dividend collected, and much more. If you find value in this content, please consider liking the video and subscribing. It truly supports small creators like myself in reaching a larger audience. So without any further delay, let's get into it. Since starting this journey in 2020, my portfolio has grown from just over 18,000 to more than 39,000 in 2026 year to date. That's not from hitting a lottery stock, using options, or trying to get rich overnight. It came from consistency, dividend growth investing, and continuing to buy quality companies month after month, even when motivation wasn't always there. Looking back at these numbers, the biggest thing I noticed is how slow the beginning felt. The first few $1,000s took time. It honestly felt like nothing was happening, but eventually the snowball started getting bigger, and now the yearly increases are becoming much larger than before. From 2020 to 2021, the portfolio grew by around $2,400. From 2024 to 2025 alone, it increased by more than $10,000. That's the power of consistency mixed with compounding. Right now, the portfolio has a weighted dividend yield of 2.28% with a projected annual dividend income, also known as PATI, of approximately $707 per year. That means the portfolio is now generating nearly $60 per month in forward annualized income without me needing to sell the shares. And what's interesting is that the dividend income itself is starting to snowball too. Every dividend payment buys more shares. Those shares produce more dividends, and over time the cycle repeats itself. One thing I want to point out is that this portfolio was not built by chasing the highest yield possible. My focus has been on high quality businesses with strong balance sheet, durable competitive advantages, and long-term dividend growth potential. There were definitely moments where the market tested my conviction. Some positions underperformed, some stocks went negative, and some months felt discouraging. But staying invested during uncertainty is part of the process. One thing I learned is that building wealth through investing is honestly pretty repetitive. You work, you invest consistently, you reinvest dividends, and then you repeat the process over and over again for years. It sounds boring, but boring is usually what works here. The year started with a solid momentum as the portfolio gained 1.81% in January compared to the S&P 500 1.14% return. February continued that trend with the portfolio rising 3.3% while the broader market slightly declined to minus 31%. During the first 2 months of the year, the portfolio demonstrated resilience and stability, benefiting from a focus on high quality businesses and long-term investing principles. March brought significant volatility across the market and my portfolio declined by minus 5.5%. Although negative performance is never enjoyable, the portfolio still held up better than the S&P 500, which dropped minus 7.7% during the same period. The market rebounded aggressively in April and May. My portfolio gained 4.26% in April and 4.78% in May, which are both strong monthly returns. However, the S&P 500 advanced even more during those months, returning 5.07% and 10% respectively. This underperformance during sharp rebounds reflect the nature of my portfolio. Rather than being heavily concentrated in high-risk growth names, the portfolio is designed around consistency, dividend growth, and long-term compounding. As a result, it tends to perform better during market downturns while sometimes lagging during powerful rallies. Overall, I'm pleased with the performance despite lagging the market. This is not a normal year. This is the hype AI year where some companies get overstretched with their stock prices while fundamentals say an opposite story. Demand is high right now, but eventually it will cool off and not all companies will remain victorious. So as of now, I'll stick with what I'm doing. My portfolio is structured with a strong core of high quality compounders balanced by supporting positions that add diversification across sectors, income stability, and long-term growth potential. The largest holding is Google at 12.94%, which acts as the main growth engine of the portfolio. It is followed closely by a second tier of core positions that sit between roughly 6 and 8%, including Texas Instruments, S&P Global, Automatic Data Processing, Visa, Microsoft, MasterCard, and JP Morgan Chase. This group forms the backbone of the portfolio when it comes to the price movement, combining strong earnings growth, competitive advantage, and consistent dividend growth. The next layer, ranging from about 3 to 5%, includes Johnson & Johnson, Apple, Kroger, Realty Income, and AbbVie. These positions add a middle ground of stability and defensive characteristics, particularly through healthcare, consumer staples, and real estate exposure, while still contributing meaningful dividends and steady growth. At the smaller end of the portfolio, ranging from 1 to 3%, we have PepsiCo, Waste Management, Colgate, Home Depot, Nike, and Procter & Gamble. These smaller allocations help diversify the portfolio further into defensive consumer sectors, retail, and industrial services, reducing concentration risk while maintaining exposure to long-term steady performers. Overall, the structure shows a deliberate balance between growth and stability. The portfolio is anchored by a dominant technology leader, supported by strong financial and infrastructure compounders, and rounded out with defensive consumer and healthcare names. This creates a diversified yet focused approach designed for long-term compounding, dividend growth, and resilience across different market cycles. This month, I kept it simple and focused entirely on quality. I didn't deploy massive lump sums. Instead, I chipped away at 3 legendary dividend stocks. First up, we have Visa and MasterCard. These two essentially own a global duopoly on credit and debit card processing. Every single time someone swipes a card, handles an online checkout, or taps their phone anywhere in the world, Visa and MasterCards take a tiny percentage. They don't take on credit card debt risk like banks do, they just provide the tracks for the money to flow. Then we have S&P Global. If you ever heard of the S&P 500, this is the company behind it. They control massive credit rating modes, data analytics, and indices. Companies have to pay them to rate their debt. It's an incredibly sticky, high-margin business model. None of these three are high-yielding dividend stocks right now, but their dividend growth rate and capital appreciation history are phenomenal. They are compounding machines. Adding 0.58% shares here or 0.30 shares there might not look like a massive portfolio shift today, but when you compound these fractions over 5, 10, or 20 years, those little streams turn into rivers of passive income. In May, my portfolio generated a dividend income from a broad mix of high-quality businesses across multiple sectors, highlighting the strength and consistency of my long-term income strategy. A meaningful portion of the income came from technology and payment-related companies, which continue to demonstrate strong profitability and shareholder return. These businesses tend to reinvest heavily while still rewarding shareholders through steady dividend growth, reinforcing the balance between growth and income in my portfolio. Those companies are Texas Instrument, $13.04, MasterCard, $3.96, Apple, $1.27, Visa, $4.75, Procter & Gamble, $3.29, AbbVie, $10.41, Colgate, $4.44, Realty Income, $5.93, Kroger, $7.28, Starbucks, $11.37, Hershey's, $22, Microsoft, $5.47, and Johnson & Johnson, $9.45, for a total amount of $102.65 in dividends for the month of May. Now, you might have noticed that some of the dividend payments have an asterisk. This is for the early dividends. Early dividends is a new feature on Robinhood, which is the brokerage account I use for this portfolio, and it just means that eligible stocks will pay their dividends 1 month in advance. This does not bring any sort of advantage or tax benefit, just receiving my dividends earlier. So moving forward, I'll continue putting the asterisk unless this affects every single holding. Also, this early dividend feature will alter my dividends year-over-year graph when it comes to the growth and percentages, but that is okay. Overall, my total dividends are moving in one direction, and that is up. As mentioned, you can see how 2026 stands out of the crowd due to the early dividends, but the story remains the same. It started in 2020 with almost no meaningful dividend income, just the beginning stage of building the portfolio. In 2021-2022, income grew rapidly as compounding began to take effect, showing clear momentum from consistent investing and reinvestments. By 2023, the income became meaningful and it felt like a real cash flow stream. In 2024-2025, growth slowed and moved more sideways, with smaller changes year to year as the portfolio consolidated and continued compounding at a steadier pace. Then in 2026, income surged significantly, nearly doubling from previous years and setting a new high due to the combination of pending dividends and early dividends. Now you're seeing the annual dividend. This breakdown of my portfolio shows exactly how my dividend income is structured on a yearly basis, and it highlights how compounding creates a layered system of income over time. At the top, a few positions clearly dominate and act as a main income engine. One of the biggest contributors is Realty Income, which alone produces a very large portion of my annual dividend and serves as a core income anchor of the portfolio. Alongside it, strong contributors like automatic data processing, Texas Instrument, and Starbucks consistently generate high levels of cash flow and form the backbone of my passive income stream. In the next tier, there's a strong group of reliable compounders that provide steady and meaningful income each year. Companies like AbbVie, Johnson & Johnson, Verizon, Pepsi, JP Morgan Chase, and Waste Management sit in this core group. They don't necessarily dominate individually, but together they create a stable and diversified foundation of income across healthcare, financials, consumer staples, and industrial services. Below that, there's a wide base of smaller but still important contributors. Positions like Apple, Microsoft, Visa, MasterCard, Procter & Gamble, Colgate, Nike, Home Depot, Kroger, and Alphabet all contribute smaller individual amounts, but together they significantly strengthen diversification and reduce reliance on any single source. Overall, what this shows is not just a list of dividend payments, but a structured income system. A few major holdings drive a large share of the income, strong middle tiers provide stability and balance, and a wide base of smaller positions add diversification and long-term growth potential. Over time, this structure is designed to keep compounding, where each layer continues to grow and push total income higher year after year. Then we have the invested capital versus capital gain or loss. This is a chart I created to showcase in full transparency the amount I have invested and how much I'm making or losing currently. This is like the total return, but in numbers. The blue bar represents the amount of money invested and the white bar the gain or loss. Due to character limitations, some numbers are not visible. Again, this is just for transparency purposes, as I like more the total return chart. So if you wish to pause the video so you can read the numbers carefully, this is your chance. Now we have the full picture of my portfolio's total return, and it really shows how uneven but powerful long-term investing can be when you zoom out. At the top, a small group of holdings clearly stands out as the main performance drivers. A few positions have more than doubled, and one has even gone well beyond that, acting as one of the biggest engines of growth in the entire portfolio. Alongside that, several other strong performers have delivered returns in the 50s to 150% range, showing what happens when quality companies are held through different market cycles. These winners are what carry a large portion of the portfolio's overall performance. Then there's a strong middle group of solid performers. These holdings have delivered moderate but still meaningful gains over time. They may not be the headline numbers, but they represent steady compounding. Businesses that have grown consistently and rewarded patience. This group plays an important role in balancing the portfolio, providing stability and reliable long-term returns. Below that, there's also a set of holdings with low or even slightly negative total returns. This is the part most people underestimate in investing. Not everything works at the same time. Some positions move through long periods of underperformance due to valuation resets, slower growth phases, or broader market headwinds. Even strong businesses can look flat or negative over certain time windows. What stands out most is how concentrated the results are. A relatively small number of strong winners are doing most of the heavy lifting, while a mix of average and lagging positions make up the rest. This uneven distribution is completely normal in long-term investing and is actually one of the core drivers of index-beating performance over time. Overall, the portfolio tells a clear story. Patience with strong companies leads to outsized winners. Average positions will still compound steadily, and even underperformers don't prevent long-term progress. When everything is combined, the strength of the winners more than offsets the weakness, reinforcing the importance of staying invested and allowing time to do the compounding work. That will be it for this portfolio update. If you made it to this part, thank you so much for watching. Consider liking and subscribing for more. I'll keep updating the journey as the portfolio grows and the dividends keep building upwards. Thanks for watching, and I'll see you in the next one.